Very good morning to you all. And the topic that we shall start today is capital asset pricing model. Um, from a second look, it feels that this is not the new topic which I'm discussing with you. In fact, I have been talking about this topic for a long time. Uh, so we discussed CAPM even before we start discussing formally today. But CAPM is a fantastic theory. It's a theory which creates a benchmark of the minimum return which the investor must earn. So it basically levels a bottom line that anything which is below the return on equity determined by CAPM, capital asset pricing model, is basically unacceptable to the investor because it's not able to cover the cost of equity. So that's something we shall discuss today. And then we will go to Jensen's Alpha, which is a fantastic tool to check the performance of a company. So we move on. So CAPM is often used when you are labeling the securities, the stocks, based on their riskiness. And the risk in this case is the market risk measured by the coefficient of beta. Um, so as I said that the risk element in this case that we are considering is the beta coefficient. And you all know by now that how to calculate the beta. You can see the headline beta, which is available in the stock market, of course. If you see some standard website like Yahoo Finance or Reuters or Wall Street Journal or investing.com. So these are, often the headline beta is available. But in this course, my stress is that you should be able to calculate these statistics by yourself. Okay. So in no assignment, I would be accepting the headline beta. So all the statistics which are required, you must calculate by yourself. So the point here I want to emphasize is that when you are labeling the stocks based on their riskiness, then we are making use of capital asset pricing model. The reason is that CAPM determines the required rate of return, which one must get. So as I said that it sets a bar, it sets a hurdle that anything below CAPM determined a return on equity is unacceptable. And by the way, this return on equity will not be same across the board because the companies differ. Okay, their riskiness is different. So that's why the coefficient of beta, since it varies, therefore the rate of return which one must get is not same. And this is precisely the job of this model. This model was first given by John Lintner, Jack Trainer, William Sharp, and Jan Mosen in 1964. But then afterwards, Harry Markowitz did marvelous job to develop this theory. William Sharp received Nobel Prize in economics, and Merton Miller and Markowitz. And during the 90s, this model was extensively developed. In the academic research, we use model, of course, we use CAPM model in its original form, but now we have seen that many new versions of capital asset pricing model, this CAPM, which we call it for the sake of brevity. As an abbreviation, we call it CAPM, CAPM, sometimes CAPM. So different books, different people, they use different abbreviation. The core idea is that CAPM is the capital asset pricing model, which sets a bar that which an investor must receive. And because it's the key element, the key variable in this model is beta, which is measuring the market risk. And you all know that the market risk is basically, non-diversifiable risk. We call it systematic risk. We also call it business risk. We call it macroeconomic risk. So the diversification strategy will not work when it comes to hedge the market risk. So that element, this element of systematic risk is included in CAPM, basically. And this is the core, this is the key line of CAPM, that if you want to find the cost of equity of a stock, then you need to use this formula, which is risk-free rate, RF, which is basically 10-year bond rate in any country. The best source of getting risk-free rate data. If you want to go to the original sources, then go to the central bank of the country's website and see what is the 10-year bond rate at the time of analysis. Otherwise, if you use, for example, tradingeconomics.com or Reuters or some other, or for example, Yahoo Finance, I think you can get the information about the risk-free rate fairly easily, so it's not a big problem. Definitely, you can see beta equity also. Beta equity is also called levered beta, but I'll come to that point later on. But the beta is also obtainable from the web pages, but I don't want you to do this thing. I want that the equity beta you should be able to calculate by yourself. And I think we have done several examples so far in the course when you can find beta by yourself. And then RM, so the expected market return, is the return that you get from the comparable index, basically. These are the assumptions. Every theory has the assumption. There is no theory which is assumption-less, because then there is no assumptions bring the discipline to the theory, basically. So it's not essentially a problem. The first assumption is that the investors are risk averse by nature. Well, as we discussed a few times in the class, that most of the investors are risk averse. If you see the overall, let's say we have X number of investors in the world, definitely most of them would be risk averse. They are risk averse for many reasons, because not many investors are institutional investors. So they don't have a huge amount of financial resources. So even if they lose, they can still manage it. Many people put their own savings in the stock market. So there is always a high stake, so. And moreover, not all the investors are technically or academically so sophisticated that they can become more aggressive and use this kind of risk-loving techniques. And many small investors, they are investing through the fund managers, some mutual fund or these kind of investment things. So because this money is coming from the people's savings, the small savings, therefore the fund managers are also under pressure that they don't take huge amount of risk, because otherwise, if they make some mistake, then investors lose tremendous amount of money, and then the public backlash or the regulatory noose around the neck could be very tight. So this is why we see that many investors, rather most of the investors, are risk averse by nature, but I don't see this assumption creating much problem in the reality. So this is fairly acceptable assumption. There is unlimited capital to borrow at the risk-free rate of return. That's not true, in fact, because not every, first of all, it's not right to say that there is an unlimited flow of capital available in the market, and not everybody is able to get this unlimited flow of capital at the risk-free rate. We all know that we have the companies based on their risk, based on the several factors. The credit rating is not same, and if you are AAA company, I can imagine that you can get the risk-free rate of return. So you can borrow at the risk-free rate of return, but I would still not use the word unlimited flow of capital. That is something which is big question mark. And moreover, not every company is AAA. So as you are losing A's or you're losing pluses, and depending upon which rating you are seeing, um, so then the risk premium keeps adding on to the risk-free rate. So then you can't say that you are borrowing unlimitedly at the risk-free rate of return. So yeah. Investments can be divided into unlimited pieces and sizes. So you can basically, so the investment is divisible. So you can make one investment of $1 million, or you can make 1 million investments of $1 each. But we know that that's not true. There is a minimum size of investment which you must undertake. So that is also an assumption which probably not so realistic. And then this is the most fanciful assumption, most heroic assumption. There are no taxes, inflation, or transaction costs. This is, I won't say anything about it, because you know that taxes is a reality. Inflation we encounter quite often. And when you are buying or selling the stocks, you must pay the transaction fee. Okay, so these are some of the assumptions which, to make the model simplify. In fact, when I say that the model has been refined over time, it means that researchers they have come to know that these assumptions are very, most of them are actually unrealistic. So therefore, to make the model more real, they need to modify their assumption. So therefore, the new version of CAPM, which you see in the research articles, or the practitioners' websites, you see that now this model has been modified to make it compatible to the reality, because these assumptions are not portraying any reality, except for one or two. Most of these assumptions are quite, they are not real. So this is the original. If we plot CAPM graphically, then it looks like this, that there is a risk-free rate. That's a starting point, because there is no risk, which is lower than risk-free rate, basically. And if we have beta here, so the risk-free rate of return, and then we find that as the beta goes up, then the expected return. Remember, this ER, expected rate of return, is something which you get from the CAPM, okay? And here you see that the expected rate of return from the market, RM, and the beta is 1. So the beta of the index is always 1, okay? So if you choose to pick a stock whose beta is more, then definitely you should expect that the return on the stock would be more than that of the market. And then in between, different combinations we have. So this straight line, once again, the critics, they argue that it's difficult to, it's a little bit unrealistic to assume this linear relationship, because in the real life, the relationships are not linear. So why should there be? Linear means very predictable, basically, very predictable. So for example, if I know beta, then I can forecast so exactly the expected rate of return. So researchers, the critics, they are of the view that this line being straight line is not a reality. So in reality, this SML, what we call as a security market line, should be non-linear. But anyway, that's not the point of debate at this moment. Limitations are very obvious. If you disagree with the assumptions, then it becomes limitation. So I don't think there is point of discussing limitations. So we move on. Okay, so now I take you to a spreadsheet where I have applied CAPM model, and I want to discuss it with you now. Let's do it. All right, so as I said that we will see the example of calculation by CAPM. So that's what I'm planning to discuss with you now. Okay, so maybe we take some other spreadsheet. So if I take Kone comprehensive calculations, yeah, this is here. So we can have the spreadsheet. I hope you can see it on your screen. Let me double check. Yeah, you can see it now. So Kone is a very big company in the field. It makes basically elevators, but it makes many more things. So it's like a engineering company, manufacturing. And I took the data of Kone from 2012, 3rd of April 2012 to 2nd of May 2018. And then we have the, you know, that we make all our calculation based on the closing price. And then we see the return, the daily return of Kone for this. So this is how we calculate. So I think there's nothing that you don't know about it. And then we have the OMX Helsinki index values. And based on that, we make a calculation as well. And once we know this, we can calculate beta, which is here. Remember that in the CAPM, if you see the formula of CAPM, beta, let's say you want to compare two Finnish companies, Finnair and Kone. The first input of capital asset pricing model is risk-free rate. A risk-free rate will be same for both companies. The second component is beta, which I will discuss a bit later. Then the third component is RM, the expected return on the market. Because both companies, Kone and Finnair, are in the same market, therefore the index return will be same, minus RF, which is anyway same. So the only thing which differentiates, so the only variable in CAPM, you need RF, risk-free rate, you need beta, you need RM, return on the market. Out of these three inputs, the only variable thing which vary from company to company is beta, basically. All other two components are common for the companies in the same market. So we have this beta, and we find that the beta of Kone is 0.90, so which is very risk neutral type, a bit towards riskiness. And then we found that the risk-free rate is 1%. This I took externally from Bank of Finland's website, the 10-year bond rate. So this you can get from there, or depending upon which market you are in. Then the Kone daily return was this, and because I took 6 years, so you can see that the total number of rows basically are 1,524. So 250 years, 250 working years, working days in a year times 6. So that makes almost same. And then we are annualizing it because we discussed a few times that you need to modify the daily return to the annualized return to make a better comparison. And then this is the formulation of doing it. So the daily return plus 1 to the power of 365, and then we subtract 1. And then we have the OMX Helsinki daily return, the index return basically. And then we use the same formulation to annualize it. And here comes the real show. Here we go. This is beta, basically, which means that your H5 is the risk-free rate plus F2 which is beta, multiply, the bracket starts, H9, which is the return, annualized index return, and minus H5, which is the risk-free rate. And once you solve it, it comes to be 0.17467. So if I modify to, if I format this to percentage with 3 decimal point, then it becomes 17.467. It means that the minimum return which one must expect from CAPM is 17.467. And you can say that if this beta was low, let's say not 90 but 70, then this would have been lesser. And if beta is even more than 1, then the expected return would be even more. So I can even just call it as, this can also be written as a percentage, maybe 3 decimal points. Yeah, here we go. So this is what CAPM helps us to calculate an important. And I think CAPM is something which you'll be using quite frequently, quite regularly in your task 2, 3, and 4. Okay, so it's quite important thing to know. Questions? All right. So I go back to the slides. And the next thing which I want to discuss with you, which is very important, and in fact, that is that you could see on the spreadsheet, something called Jensen's Alpha. Okay, and yeah, so CAPM is the model which provides us the minimum return, and if we solve these mathematical equations, we find a concept called Jensen's Alpha. You don't worry too much about the theory behind it, but of course, I shouldn't say that you don't worry about the theory behind it. You should know the theory behind Jensen's Alpha. But the main thing I want to emphasize is that don't worry too much about this mathematical equation. That's not something which you should be too much worried of. But the theory of the Jensen Alpha is that let me give you an example, actually, and that example be non-financial example. In a classroom, there are 20 students, and I, being the teacher, organize a test of those 20 students. Obviously, those 20 students would be having different marks. So if I compare those students with the stocks, then I would say that the different stock return, each stock would be having a different return. In other words, each student would be having a different performance. That's what I expect. If they're having same marks, it's a purely coincidence, nothing more. And then the market return I can compare with the average. So the average grade. So if I calculate that the minimum mark is 0 and maximum is 10, and students are scoring between 0 and 10, and let's say that the average marks are 6, then the market return is 6. But when I compare each of the students, each of these 20 students, I find that some are overperforming, some are underperforming, and some just get 6. So based on the average, I can say that, hey, this student has overperformed and this student has underperformed. This is something we do when we are calculating CAPM. So we are comparing the performance with the market performance. But there's one more thing. When you compare the company stock with the market stock, market performance, when you compare the company return or the portfolio return with the market return, you are comparing yourself with others. So, for example, when you are comparing the performance of Kone with the rest of the Finnish companies, you are comparing Kone with others, basically. But what if I want to compare Kone with Kone? It sounds bizarre, but that's true. Sometimes I can compare you with yourself. Coming back to the example of students. There is a student. I know the student has been struggling in the entire course, wasn't very comfortable. I was expecting as a teacher that this student would not get more than 2. Now what happened is that when I saw the result, it comes that he or she got 5. 5 is still below 6, the class average. So when I compare this student with the class average, this student has underperformed. But when I see his or her 5 grades achieved, but I was expecting this student to get 2, this student has overperformed. So basically, when I compare this student with the rest of the class, the student has underperformed. But when I compare this student with himself or herself, the student has overperformed. On the other hand, there's another student who I was very sure would get 10 out of 10. The student has got 8. 8 is still more than 6, the class average, which means that when I see this student's performance, this student has overperformed the rest of the class. So basically this company's stock return has overperformed than the rest of the market. But you know what? I was expecting this student to get 10, but the student got 8. So in a way, the student has underperformed. So when I compare this student with the rest of the class, he or she overperformed. But when I compare this student with himself or herself, the student has underperformed because I was expecting him to get 10. This is exactly the role of Jensen's Alpha. Okay, so in CAPM, you are comparing with the use of CAPM, you are comparing the company's actual return with the minimum return, but the question is that how much was expected from this company? That's very important. So even though the actual return of the firm, the stock, could be below the average, but it still could be more than what we expect. But let's take an example. Let's go to the this spreadsheet again, which we were looking at. So I'm back at Kone, and you can see that this is the expected return from Kone. The minimum return which Kone must generate is 17.467%. The minimum, this is the minimum return, yeah? But what is the actual return of Kone? This is the actual return of Kone. So when I compare Kone, the actual performance with the market performance, Kone has actually overperformed. Let me change it to percentage. So Kone has overperformed in comparison to the market. Question is, how much has, so this is 22.045. In the same way, when you compare Kone with the market, so just compare, see this and this. Let's change this to percentage also. Coming back to my example of the student, when I compare, let's call Kone a student. When I compare a student's performance, actual performance, with the rest of the class, oh, sorry. This is the, I'm sorry, I'm completely going off the track. That is a risk thing. Yeah. Oh, yes, this is the, yeah. So this is the company's return, and actual return, and this is the actual return of the market. So when I compare this number and this number, the student has overperformed the class average. Student has overperformed the class average. Kone has overperformed the rest of the market. But question is, how much I was expecting from Kone, regardless of the market. So when I compare this and this, Kone has overperformed, basically. Kone overperformed. But then I compare Kone with the external benchmark, which is the market. But how much I was expecting from Kone, and that is given by CAPM, and that was 17.467. This is again showing that Kone overperformed. In other words, when we see the actual performance of the company with the market performance, we make a judgment, but we also need to know that what was the capacity of the company. The company's capacity as per the theory was 17.467, but the company made more, generated more return. And when we see the difference between them, the difference between the actual performance minus the expected performance. So this is called Jensen's Alpha. Jensen's Alpha is basically a comparison of a company's actual performance with its expected performance. That is the main idea of Jensen's Alpha. So basically, I'm comparing company with itself. I'm comparing the student with himself or herself, basically. So that is the theory of Jensen's Alpha. And if this is positive, if positive, then it's overperformance. So because it's actual is 22% and expected is 17.5, so it's about 4.5, 4.6 percentage overperformance is basically. So you are jumping, the bar was this, but the athlete jumped almost 5% above the bar. Well, anything positive is welcome, but in this case, this positivity is about 5%, which is really good. So it's a big margin above the benchmark. The bottom line was 17.467. So in the session so far, we have learned very important things, that how you can actually, because CAPM is a theory, yeah, it's a very important theory. It's a very widely accepted, even till today. So you are able to measure it with the data. And secondly, you are able to compare, you are able to find Jensen's Alpha. So this is a very, we have done two big things today. And if you look at your task, let me take you to, not this one, the other one. So if I take you to your tasks, you will see that your task 4 is based on this one here. So calculate Jensen's Alpha. You have your companies already for task 2 and 3. You have your portfolio. Okay. Now this time, what you do is that you can consider the portfolio as one stock, basically, and you can calculate by applying CAPM. What was the expectation from the portfolio? And then you see the portfolio's actual return. Okay. So you can make the three things: the portfolio's actual performance, number 2, portfolio's expected performance, which you can obtain through CAPM, and then you can see the portfolio's then there is a market return. So you can compare portfolio with the market return. So that would show if you overperformed or underperformed in comparison to the market. But then you also can compare portfolio return with the CAPM return, expected return, if portfolio overperformed or underperformed in comparison to its own expectations. Okay, so this is something you need to do. So basically you need to carry on task 2 and 3 and then take it on to task 4 as well. So same companies, same portfolio. So you don't have to calculate Jensen's alpha for each of the company, but I would be expecting that you'll be doing it for the portfolio basically. But if you can also calculate for each company, then why not? Because it could be possible that overall portfolio has overperformed than what was expected. But in the portfolio, you have 3 stocks, 2 have overperformed and 1 has also underperformed. It means that you need to make some changes in your portfolio for the future. So this kind of debate you can generate from this calculation. All right, let's take a short break then. Maybe 5 minutes, and then we carry on to the new topic. This is basically, we have completed our first topic. You can see that we are done. Okay, that's the readings references. Of course, I have shown, I've given many of them in the course description. So here we are. Let's take a short break, and then we start the new topic. All right, so we start a new topic, which is leverage and the firm valuation.
And can see the screen.
And yeah, sorry about it.
Yeah, now.
Now, in this topic, we will be discussing about how the leverage, which essentially is the debt, but how debt have an impact on the company's valuation. And this is quite important topic. We shall not go too much of valuation in detail, but primarily we'll be only concerned about that part of valuation which is being influenced, impacted by the company's leverage. That's what I plan to do. We need to recap something about the regression beta. Remember one thing which I want to share with you, that the beta that you have calculated in task 2 and 3 and even 4, I would say, this is called levered beta. Why we call it levered beta? Because this beta is, when you calculate it, when you calculate the stock price, it incorporates the fact that the companies also have debt. So in a way, the stock price is changing depending upon the several factors. And one of the factors which have an impact on the stock price movement is the debt. And because the debt have an impact on the stock price movement, and the stock price movement, they reflect in beta. So therefore, beta essentially, which you calculate, is in a way implicitly incorporating the impact of the company's leverage as well. Imagine a situation, the company borrows heavily. And when the company borrow heavily, it has a negative, there's a negative reaction of investors. And when the negative reaction of investor comes, in reality, the stock price will go down. And when the stock price will go down, the company's rate of return will change, and that will transmit itself, that would reflect itself in the form of increased beta. So therefore, the change in the leverage, change in the debt have an influence on the company's, what we call as a systematic risk, and also reflect. So the beta that you calculate, or the beta that you see in the headlines in the website, is also called the levered beta, or equity beta, because of course it belongs to equity. So levered beta is very important concept. So the regression beta that we calculate is very vital, but it has some limitations. And the first limitation is that the standard error could be very high. I don't know how many of you have got some previous course in statistics, especially when you use some SPSS analysis. In the regression beta, when you run the regression, you have the R square term, which is the square of correlation of coefficient. If you want, when we meet next time in the class, I can do it by myself and I can give you more detailed description of it. R square shows the power of the explanatory power of the model, but sometimes because of the high standard errors, you might have chosen wrong period. Maybe you have chosen the wrong methodology, and because of these errors, it could be possible that our explanatory power of the model, the relationship between stock price and the index value, index return, the stock return and the index return is not very authentic. It's not very objective. So this could be possible that the beta, that is a limitation of the regression beta. One more thing is that you have seen that when you calculate the beta, you might be having 6 years, 10 years, 20 years, and there is no, and we always know that the history is important, but the immediate past is more important. What would be happening to my company today depends on not what happened 20 years ago, but what has happened in the recent past. But when you are calculating the regression beta, you are not giving more importance to the recent past. You are giving equal importance to if something happened on 20 years, stock return on, let's say, 3rd of March 2002 or 3rd of March 2020. So you don't make any ranking of the time period. You never give more weight to the recent past in comparison to the distant past. That's something. And in the recent past, you might have brought many changes in the business mix, in the strategic changes, in the organizational changes. You might have launched some new product just 2 months ago. But when you're mixing that 2 months ago stock return with what happened 20 years ago, you are basically creating a mess, I would say. Sometimes too much of data, it doesn't reflect the qualitative changes. And the third mistake which you can do is that you can choose the wrong index. Okay, sometimes you can have the same company's return and you are, benchmarking it against 2 or 3 different indexes, and the whole performance, risk, return, it changes. So it's very important that you choose the right type of index. If you choose the wrong index, then the values could lose their credibility. Determinants of beta, there are several factors which have an impact on the beta. The first is the nature of product and service. The product which are demanded more regularly, for example, the food items, the staple food, bread we eat in summer, we eat in winter, so I don't think there is any difference. Juices could be, even though we drink less juices in winter, or ice cream. So those items which are consumed, which are used quite consistently throughout the year, they have less beta because the cash flow is more stable. On the contrary, if you have some product which you demand during certain season and you never demand them in the other season, or at least you demand less in the other season, that could have more beta. So for example, if you are a company providing some holiday homes, let's say some beach houses, okay, then you will be almost out of business during winter, because who would rent the cottage in the month of December? Very, very few people. Or when the snow comes, you might have to shut down the whole business. Okay, but during the time from April until September, I would say, this business is quite booming, okay, because it's a mild summer, then proper summer, extreme summer, and then even a bit of glimpses of fall. But after September or in October and onwards, this cottage rental business is almost finished. Not finished, but there's a pause for a few months at least. Not few months, but 4 or 5 months. There is no business basically. So those companies who are into these kind of businesses, they can expect a higher beta. Same way, the luxury goods have the higher beta. Why so? Because the luxury goods are, if they become cheap, then they attract more customers. Those people who used to think that this luxury product is beyond my reach, they also start thinking that now it's achievable. Okay, so the luxury goods, they are very, we use a phrase in economics that they are more price and income elastic. Okay, so when the price falls or the income goes up, people start thinking of buying the luxury products because it used to be a far cry for them before, but now it seems to be achievable. Okay, so suddenly with the fall, little bit of fall in the price or a little bit of increase in your income, there's a potential customers who are willing to buy the luxury products. Okay, so it has a higher beta often. Okay, I remember one example I saw a few years ago. The first energy is making essential goods. The name itself tells that it's an energy company. Its beta was 0.2 or 0.3, very less. But then we had one more company called Taylor Wimpey, which makes very expensive holiday homes in Dubai, in Bahamas, in Barbados, and all those luxury places. Its beta was, I think, about four times riskier than the rest of the market. So if the stock price or the market goes up, and the Taylor Wimpey's stock return will go up by 4 times, but if the market drops by 1%, then it will lose 4%. So very high level of beta. Generally, the growth companies have higher beta. The tech companies have higher beta. All these new growth companies like technology firms, biotech companies, media companies, R&D types of firms, they usually have the higher level of beta. Okay, so before we go into the deep down discussion of leverage, it's very important that you are familiar with the phrases. So beta will not leave you still. It will still carry on with you, and it will also go to the next topic. So this is something I want to discuss with you today. I want that you should now carry on with your tasks 2, 3, and 4, and also get some basic feel of beta once again. So it's more like a recap of beta. And then very importantly, the factors which have an impact on beta. All right, so I want to ask you, can you recall, can you think about some factors other than the listed here, which can have an impact on the beta coefficient? Do you see any other factors which have an influence on beta? High price goods have higher beta. The low price goods, essentials, for example, the food items are generally low priced because food is very regulated, at least the basic food. If the price drops, we don't start consuming more of it. And when the price goes up, we don't stop consuming of it. So therefore, food is a very low price or income sensitive. So with the change in the food prices, the revenue or the stock price of the food producing companies also doesn't change too much. So they are generally expected to have low beta. But on the other hand, if you have the processed food, the luxury food, the expensive one, then all else being equal, I would assume that they are more price or income sensitive. Some food which is of very high quality and you are not able to afford it because you are not having that much of income, or the price was very high, but now the price drops and your income increases, you start consuming the high quality food, and then that would also reflect on the revenue of the companies making it and the stock prices, and then they would have the higher beta. The growth companies are risky. They grow very fast. When they grow very fast, they overgrow, and they rather outgrow the rest of the market. But when they drop, they just drop like a pack of cards and simply disappear very often. If you look at the growth companies which developed this IT boom during the mid-90s in the US, Silicon Valley, and then you see that when this bubble bust, you know, 70 to 80% of those companies, they just disappeared. On the other hand, the value-based companies are more old-fashioned. They are old economy. They are like Warren Buffett type of companies which grow not very fast, but they are growing in a very stable manner, very consistent manner. Okay. So do you see any other factors in your mind, you think, which could also have an impact on the beta?
Maybe if this company is government, beta will higher.
Sorry, could you say it again? You mean the governance?
Yeah, if government has this company, maybe beta will be higher, like a government bank or something like this.
Ah, okay. So you think that the companies owned by the state have high beta?
Yes, I guess this.
But what is your rationale behind it? What is your argument behind it? On the contrary, I would think that those companies which are strongly supported by the state, they should have low beta, because beta is a reflection of riskiness, the market risk. And the state-owned companies get a lot of support from the state. So in other words, even in the crisis time, they would get a lot of subsidies and a lot of bailouts from the state, and they would survive. On the contrary, the private companies, which are not getting so much of support and assistance or patronage of the state, they will not be able to survive, or they will not be able to, they may be in an unfavorable situation in the time of crisis. What do you think?
My mention was based on maybe political change, and if something
You mean the change of government?
Yeah, political change. Company
Okay.
which are government have more troubles like private.
Okay, I think I was thinking that those companies which are owned by the state, because there are companies which are largely the ownership of state is substantial. Like you see many Finnish companies, the state of Finland is a very big investor in those companies. So yeah, but yes, I get your point that if there is a change in the government, if there is a climate of political uncertainty, you are almost on the verge of elections. Like you can see in the US that now the elections are almost there, and still situation is unclear. Okay, so then the many investors, they hold back their investments, and because they feel that the riskiness is more if they choose to invest. So they rather, if they're risk lover, they go for it. But if they're risk averse, they are playing it safe. Yeah, that's a good point. That the institutional environment, the organizational environment, the political environment, they play a very important role when it comes to the market risk. Because the government will be making the new macroeconomic policies, and the macroeconomic risk is basically the systematic risk. So that would push beta up. Very good point, Alexei. Good job. Anybody else has something to contribute? If not, then we close our meeting now, and we will carry on, because I want to discuss those calculation part of this topic. when we meet in the classroom, and that is tomorrow. So tomorrow we shall do some calculations based on topic 2, and then we will move on. It's not a very long topic, so I think we'll be able to finish it pretty fast. So that's it from my side. If you have any comments, questions, you can ask me or share with me. Otherwise, we shall meet tomorrow. So it seems that you don't have any questions. So then I say you bye for now, and let's meet tomorrow, and have a nice day.
Thank you. Bye.
Thank you very much.